This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on always in trading. In this video, I'm going to be talking about the characteristics of trading when the market is always in long and when it is always in short. Always in long, that means that if I had to be in the market long or short, I want to be long. It simply means that more dollars are on the buy side. There's more buying pressure than selling pressure. Compare the strength of this rally to the strength of that sell-off or the strength of this sell-off. The rally is stronger. So higher prices are likely, and I think it's better only to look to buy. What do you buy? Well, there are many ways to buy. You can look to buy pullbacks. The key is your stop location. The stop is down at the bottom of the bull breakout. Whenever the market has a high probability of doing something, the risk-reward is usually bad, and that means the stop is usually far away. Buying anywhere in here, you're probably going to make money, but you have to use the correct stop down here. Bulls, they'll buy that close, they'll buy above this bar. Those are not ideal. Maybe they'll buy this pullback, but 8-bar bear micro channel, better to take a second entry buy here. Also small wedge, 1, 2, 3, nested wedge, 1, 2, either one of those, and then 3. Around a 50% pullback from the original breakout and a reversal bar. So buy above this bar, or if you prefer to buy above a bull bar closing on its high, you buy above here, or you buy any of these other bull flags. It doesn't matter where you buy. If you buy at the market here, you buy closes, buy below bars, buy above bars, buy these pullbacks, the stop is the same. It's below the bottom of the bull breakout. Here's a 5-minute chart of the euro versus the dollar. Very strong bull breakout. Clearly always in long. Clearly the odds are it's going higher rather than lower. Stop way down here at the bottom of the bull swing or at the bottom of the bull breakout bar. Again, you buy for any reason. You buy at the market as this bar is forming. You buy this bear close, betting the reversal will fail. You buy below bars. You buy above bars. And as long as the market keeps forming higher lows, especially higher lows that are major, reasonably strong bull breakout to a new high, this is a major higher low. Here, a higher low, and then we get a pretty good bull breakout. This is a major higher low. As long as it continues to form major higher lows, bulls will keep buying pullbacks, and they'll buy for any reason. Initial stop down below the bottom of the bull leg, and then after each strong breakout to a new high, bulls will trail their stop. They'll raise their stops to below the most recent major higher low. And they'll keep buying. They'll keep buying until there is a credible top. Triangle, 3 pushes down, 1, 2, 3. Does not matter that this high went above that high. The pullback began here. Sometimes part of the pullback is at a new high. Bears trying to reverse, a wedge, 1, 2, 3, wedge, 1, 2, 3. Trends are constantly trying to reverse, but unless there's a clear major reversal, traders will continue to buy. So a high 1 buy, high 2 buy. Triangle, late in a bull trend, often becomes the final bull flag before you get a pullback or a reversal attempt. So a lot of the bulls might exit over here. A micro double top, up, and then a bear bar, and then up again, and then a bear bar. Might be evolving into a trading range, so a lot of bulls will exit there. Always in short, so if the market is probably going to go lower, you want to be short. Always in short means you believe the market is going lower. That means there are more dollars on the sell side, more traders interested in selling. And as a result, you get more selling pressure than buying pressure. Compare this selling with this buying and this buying. The bears are obviously stronger than the bulls were here. And here we get 4 more or 5 more bear bars and only 1 bull bar. Probably we're going to get trend resumption down after this trading range. And because lower prices are likely, traders should look to sell. They can sell for any reason. When the market's in a trading range like this, a pullback, a lot of traders prefer to sell pullbacks, a low 1 short, low 2 short, head and shoulders top bear flag, a low 1, low 2. Doesn't matter what you call it. Bear flag, bear breakout, a 2-legged pullback. Doesn't matter. Traders are looking to sell breakouts below bars, betting that the trend down will resume. Until there's a strong breakout, traders are going to keep their stop above the most recent strong bear breakout, the most recent major lower high. When do they lower their stop? Maybe at this point, after 5 bars down, they might lower their stop to above here or above here. Again, traders will look to sell pullbacks and sell for any reason. They'll assume that any rally attempt will not get above the most recent major lower high. And they'll hold through reversals. An always in short trader, will he get out here? No, probably not. Would he get out here? No. Would he get out here? No. So he's going to hold short with the stop up here until we get a breakout or a breakout, and then he'll tighten his stop. Some traders are scalpers, and they short and scalp out, short, scalp out, short, scalp out. Most traders should not do that because they'll find it hard to sell again. So it's better simply to stay short, get short for any reason, take any one of these sells or sell this breakout, and hold with your stop in the appropriate place and let the trade go as far as it will go. Here we got a pretty strong bull trend, a bull flag. Then we got a bear breakout below the bull flag. And then we got a bear breakout and follow through. So somewhere in here, traders are concluding that it's no longer always in long. Even though this might simply be a 50% pullback in this bull trend, a very tight bear channel, and now we're starting to get bear bars and consecutive bear bars. So probably traders will sell the first reversal up, which means it's probably better to be short than long. So you got 3 bear bars, you got 9 bars down, always in short, probably sellers above these bars, and we'll probably get a second leg down. Wedge, 3 pushes up, 1, pullback, 2, pullback, 3. So a low 3 short, about a 50% pullback of the initial sell-off. And we got a second leg down, we got a third leg down. Traders are looking to sell. A low 2 bear flag, a wedge bear flag, a pullback near the moving average, around a 50% pullback. Gap bar, reasonably strong sell-off. It's a gap bar for the bulls as well, but the channel down is too steep. The bulls would need a double bottom. They did not get it. And for the bears, bear trend and a gap bar, short below, but a gap bar usually means there's not too much more left to the trend. If the bulls are strong enough to put a bar completely above the moving average, they're probably strong enough to limit the downside and convert the market into a trading range before long. You can call this a low 2, low 1, low 2, or a low 3, triangle, 1, 2, 3, or triangle, 1, 2, 3, 4. But it's another bear flag, so traders will sell the breakout or the sell below that bar. Down here, gap bar, probably not much more down, and we're still above this low, and 3 pushes, 1, 2, 3. Strong enough breakout again here for a second leg down. Strong enough breakout here for a second leg down. Second leg down. Second leg down here is strong enough, so we'll probably get one more leg down. And the result is a wedge bottom, 1, 2, 3, and a higher low. Also, look at the height of the breakout. The open of the first bar, close of the final bar. That often results in a measured move down. So down here, we're around a measured move down. We have a wedge bottom and a higher low. If the market starts to turn up here, the bears will exit, and bulls will start looking to buy. It's not always in long here, but bulls will start believing that it's always in long somewhere in here. An always in trade usually begins with some kind of a breakout. Here, you can call it a wedge top, you can call it a final bull flag, a second final bull flag, doesn't matter. We're starting to trade down, and then here, we got a big bear bar, breaking below this attempt at a bull flag. The bulls were hoping for a double bottom bull flag, maybe a wedge bull flag. They were hoping for the market to stay above the bottom of the wedge. Instead, we got to close below the low of the past 10 or 20 bars, the biggest bear bar on the screen, and there's a good follow-through bar. At this point, or this point, traders are concluding the market's always in short. At a minimum, they're expecting at least a second leg down. So we have consecutive big bear bars closing on their lows, and we have a bear breakout with a good follow-through bar. Odds are we're going lower. You can sell for any reason. A lot of traders like to sell pullbacks. They feel like their stop is closer. A lot of traders do not feel comfortable selling at the market or selling breakouts, so they sell pullbacks. They either sell above bars or with stops below bars, betting that the trend will resume down. Initial stop, top of the bear trend, but then once you get a strong breakout like this, if you're selling down here, your stop is above the top of the most recent major lower high. It's major because it's followed by a very strong breakout, and especially if it goes to a new low. Is this a major lower high at this point? maybe not. But once we get down here, then this is a major lower high, and traders will put their stop here, maybe here. You stay short as long as there is no credible buy setup. And if there is a credible buy setup, then you get out of your short and you possibly get long. So strong bear breakout, spike and channel, 3 pushes, 1, 2, 3. You might expect a couple legs up, maybe 1, 2. Well, that's only 5 or 6 bars, and that's not really enough to correct this. So we'll probably get more up. But look down here. It's a low too short. Are we always in long here? Bull breakout, not really good follow through. Bull breakout, follow through, and more follow through. Are we always in long? It might be, but compare the strength of the sell-off to this rally. We're still below the most recent major lower high, and the rally lacks consecutive big bull trend bars and has a lot of small bars with prominent tails. While we're going up, and some traders might think of this as always in long, and they'll trade it long, realistically, it's still more likely a bull leg in either a broad bear channel or in a trading range. I think we're probably still always in short, although I don't have a problem exiting at any point, especially here. Breakout, follow through, we have a wedge bear flag, and we're getting a bull breakout. Not so strong that I'm expecting a lot more up, but we might go a little bit more up. But if you do get out of your shorts, or if you do get long here, you have to look to sell again below a strong bear bar, betting that the resumption down will begin. We have a low 2, and then we have a bull reversal, so a lot of bears will exit above that bull bar, and then just wait for the next sell signal before selling again. Always in short still, but a lot of bears will get out and not get long. Many always in traders will step aside. Here, we're still always in short, but enough of a reversal so that we're probably going higher. So a lot of bears might get out, maybe above the high of this bull bar, because it's a bear flag, or we're getting a bull breakout, might go up for a measured move up. The trader still considers himself an always in trader, but sometimes he'll step aside for a few bars. This is unusual to step aside for that many bars. A lot of traders will buy above the high of this bar or that close, knowing that we're probably not going much higher, but they'll take a chance. If you did get out here, or if you went long here, you're still always in short. You have to look to sell again, usually below a bear bar, like here. It's a pretty tight bull channel, but it's a nested wedge, 3 pushes, 1, 2, 3. Different ways to draw it, 1, 2, 3. And then you get a bear bar, and you got a slightly lower high. So we're still below the top of a major lower high. So it's a double top lower high, bear flag. And we never clearly went always in long. If the bears get out here, if traders bought here, they go back to short here. Big down, pretty big up, probably trading range, but still always in short, so traders will sell here. And until the bulls get a credible buy setup, bears will keep selling. Higher low, major trend reversal here, head and shoulders bottom, left shoulder head, right shoulder. But 6 or 7 bars down, a low probability buy. Here, now we have a double bottom, higher low, major trend reversal, wedge bull flag, maybe 1, 2, 3. This is a better looking higher low, major trend reversal. Bear trend, bull breakout. Too much selling pressure to take this buy, but now we have a double bottom and a micro double bottom. We have a first entry buy here, a second entry buy here. Both have bulls signal bars. This is a good area for the bears to get out, and a lot of bulls will get long here, taking a chance that we're going to get a major reversal. So bears will take profits where the bulls will buy. If you're not particularly good at exiting and then selling again, then you just stay short and ride through this rally, looking at it thinking that it's a weak rally, so at best it's probably a bull leg in a trading range, and that will come back down to this price level. And if you're disappointed by the extent of the rally, you can get out break even. Protective stop, again, above the most recent major lower high. I would take profits here if I were always in short. If I sold for any reason, this is where I would take profits. A credible double bottom, higher low, major trend reversal, and a wedge, higher low, 1, 2, 3. And a second entry buy, both buy signal bars, having bull bodies, and this one closing on its high. This is fairly difficult. You're looking at the market not doing much, and then you see a bear breakout and follow through and more follow through. You know the market's going down, and you know your stop is up here. So what do? You have to sell. You can sell closes, sell the market, wait for a pullback, but you're risking missing a big bear trend if you're waiting for a pullback. It's usually better just to sell a close put a stop up here and trade small enough so that you don't lose more than you could typically stand to lose. A lot of traders like to sell the close. It's probably a sell the close bear trend here or here. So bears will sell closes all the way down. You don't have to sell every close, but sell at least one. You know your stop is here, so trade small enough. If you're planning on selling more, if we pull back, you have to trade small enough so that the combined position is not so big that you are risking more than you do in any other trade. A good way to enter, as soon as the bar closes near its low, you just hit sell the market. I call that sell the close. Stop above the top of the most recent major higher low. Major because a very strong bear breakout and a new low. It should not get up above this bar if it's still in a bear trend. And you're selling because you believe it's in a bear trend. And you're selling because the probability is that it's in a bear trend, 60% or higher probability that we're going at least a little lower. Again, if your stop is far away, your risk is big, so you have to trade smaller. Some traders are not willing to sell closes or sell at the market as it's falling. Instead, they wait to sell a pullback, believing that the breakout is so strong that the first pullback will attract sellers and it will be followed by lower prices. Trying to reverse, do you think this is going to lead to a reversal, or do you think it's going to lead to a bear flag? Probably a bear flag, so you sell below bars, either there or a low too short here. When the market's clearly always in long, your stop is below the most recent major high or low. Well, at some point in here, traders assume it's always in long. Stop goes here, and they're disappointed by that. However, is that enough to make it always in short? No, so it's still always in long. You might get out here and then buy again above a bull bar here or here, but it's still always in long. Pretty good bull breakout here, probably trend resumption. Even though it did not go to a new high, a lot of bulls will view this as a major higher low, and they'll put their stop here. And certainly at this point, when we're at a new high, this is clearly a major higher low, so they'll put their stop here, maybe even here after this bar. Here, the bears tried to break out, failed. Tried to break out again, failed. If the bears repeatedly try to do something and fail, they'll probably stop trying, which means the market probably will have to go higher to find sellers. Small double bottom, micro double bottom, around a 50% pullback, and this is clearly stronger than this, so still always in long. In a bear trend, stop is above the top of the bear trend or the top of the most recent major lower high. Strong bear breakout, so stop is up here. Is this strong enough to put the stop here? Or is this part of a trading range and we might go a little bit higher? I don't know. You can argue that this is a strong enough bear breakout so that it should not get above these bars, and you could tighten your stop. After this, 3 consecutive good bear bars closing on their lows, traders would trail their stop down, either to above the high of this sell climax or the high of this bear leg. Resistance is a magnet. If you have a stop here, that means you believe it's resistance and the market will not get above it. But very often, the market will try to get to it and test it. Rallies get vacuumed up to test stop locations, and if the bears are still in control, they'll prevent the stops from getting triggered. They'll sell anytime it gets near a stop. We tried to reverse up here and failed, and we're trying to reverse up again a second time, higher probability. Bear trend, bull breakout, lower low, major trend reversal, maybe a final bear flag. Is this enough to make it always in long? Well, I usually like to see consecutive big bull trend bars closing on their highs. We have a bull bar, bad follow through, bull bar, bad follow through. Even though we're above that high, it's possible that we're still always in short. This is good for the bulls. They needed one more bar. Instead, they got a bear bar. So to me, this is still probably always in short. I'm not opposed to being long here, betting that the first pullback will be bought. But the bears, I think, have to be thinking about selling below a bear bar, maybe below this bar, maybe wait for some more selling. Most reversals fail, even strong reversals like that and like this, especially when you see bad follow through, close barely above this high. This is not clearly strongly bullish. It might be a bull leg and a broad bear channel, or in a trading range. So bears will sell. They see a strong bull breakout. They believe it's going to fail to have good follow through buying, so they'll sell that close betting on the next bar being a bear bar, and they'll sell the reversal down, failed breakout. And the same is true here. A bull breakout, but bad follow through after this bull trend bar, not a particularly strong buy signal bar, and bull breakout here, but big tail. Traders will sell the close. They'll sell with a limit order at that high. They'll sell a reversal down, taking a chance that this is simply a bull leg in a trading range, which would be a pullback on a higher time frame chart. And they'll bet that we'll get a second leg down despite all of this. This is also an expanding triangle. You can use any of these highs, 1, 2, 3, and then low, lower. So an expanding triangle bear flag. It's really pretty neutral, but the bulls never did enough to convince traders that they were in control. Even with all of these bars and the probability getting close to 50-50 for the bulls and bears, the bears still have a slightly higher probability. And I think we're still always in short, so better to look to sell. In this video, I talked about some of the characteristics of always in long and always in short. I'm Al Brooks, and thank you for watching the Brooks Trading Course. This is the end of the second of 3 videos on always in trading. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on always in trading. In this video, I'm going to be talking about scalping and swing trading based upon the always in direction. Whenever the market's in a trend, traders can trade in that direction for any reason. For example, here we're starting to break below a bull channel, and we have 4 consecutive bear bars closing on their lows. Maybe by this third close, traders see it as always in short. So traders will start to sell for any reason. They'll sell at the market. A lot of times they'll wait for the bar to close and then sell at the market, and they get filled on the open of the next bar. Remember, always in trading is a way to help you trade. A lot of traders are always struggling about when should I enter. Well, you can enter on any bar of the chart. On any chart, any time frame, always in trading helps you enter in a direction where you have a better chance of making money. If you can tell the current direction of the market, whether it's long or short, going up or down, you can simply enter at any time for any reason and use the appropriate stop, trade small enough so that if you lose, you do not lose more than you do on any other trade. So always in short, we're getting a bear breakout below the bull channel. We tried to get a bull flag, tried to break out twice, failed, and now we're getting a series of consecutive bear bars closing on their lows. Probably the bulls will give up here, and those who do not were looking for any kind of bounce that would allow them to exit with a smaller loss. And the bears who did not sell are looking for a bounce so that they can sell as well. So after a breakout like this, reasonably strong, odds are any pullback will be followed by at least one more leg down. What can a scalper do? Well, he can sell at the market, take profits. Sell next close, take profits. If there's a pullback, sell the pullback. Sell the reversal up, sell the reversal back down. And use the appropriate stop, which is usually a swing stop. So the initial risk is actually much bigger than the profit target, but the actual risk usually is not. The probability is high enough that you'll make money by shorting that the math is okay. So for example, if you sell anywhere in here, the stop is up here, the top of the most recent major lower high that led to a strong bear breakout. And we got a pause, an inside bar. You can sell below the low of that bar. You could sell the close of the pause bar, arguing that it's an attempt to reverse, and reversal attempts will fail. Likewise, you can buy above bars. Again, stop entries, sell below bars, betting that the trend will continue down. Even here, your stop is above the top of the most recent reasonably strong bear leg. This is probably a major lower high. Maybe this is more major because it has a stronger breakout. But if you sell here, you hold short, whether you're scalping or swing trading. If you're scalping or swing trading, you may want to add on below this bull bar, micro double top, up, down, up, betting on trend resumption down. Now, a scalper, he's looking for quick profits, exiting within a bar or 2 or 3 or 4. Now, if a scalper saw this and decided always in short, and he decided to trade it with a series of scalps, he would have 1, 2, 3, 4 scalps. And if he managed them all correctly, he would end up with a pretty good profit. The problem is that a lot of traders trying to scalp, they'll take one and take their profit, and then they'll fail to take the second, third, or fourth entry. He'll end up not taking enough entries, and he'll end up with 1 or 2 scalps profit, which is far less than what a swing trader would get. A swing trader would sell here, or any reason, and hold as long as the market is always in short. So for most traders, when there's a clear trend, they will make more money by swing trading than by scalping. Let's say a swing trader decided not to sell these closes. He waited for a pullback, an inside bar, and he sold below this low. And he held until the end of the day, somewhere down here. The market never clearly became always in long, not even here. No consecutive big bull trend bars, no rally above a prior lower high. There's no strong reason to exit here. If he did exit, he would get short again below a bear bar and sell on this bar as it fell below that bear bar. Otherwise, he would hold until the end of the day and get out here. And he will have made more money selling here and exiting here than a scalper, even though there were 4 scalps, 1, 2, 3, maybe 4. As I said, traders trying to scalp when the market is trending usually do not take enough trades to end up making as much as a swing trader. Here we have a bear trend, but it's weak. It drops for a few bars, goes up for a few bars. It's making lower lows, lower highs. Does a bull buy here? Does a bull buy here? Probably not. Does a bull buy above this bear bar? It's hard to tell. Therefore, most of the time when you're trading, you're confused. You're never really certain when a reversal is strong enough to conclude that the always-in direction has changed. Or sometimes you conclude it after the market has already gone fairly far. For example, maybe always in long here, maybe always in long here. You don't buy the reversal, you wait for higher probability, you wait for a breakout, follow through, series of bull bars. And a lot of traders prefer to wait for a higher probability trade. Instead of buying here, here, or here, they'll wait for that or for that. At that moment, the probability is higher that the market is going higher. These traders enter for whatever reason at any time, and they stay in the trade until there's a clear opposite trend. Bear who sold here, or for any reason, he would hold short, maybe get out above here, micro double bottom, wedge, 1, 2, 3. Does not matter that this is above that. You can call it a double bottom and a breakout that failed, reversing up again. Well, the bear who sold anywhere in here would get out maybe here or here. And the bull who bought here or here would hold, well, I think he would continue to hold all the way to the end there. So big bear breakout bar closing far below a bull channel and below the low of the past 10 bars. Who knows how many bars there are to the left there. But a huge bear trend bar. Most traders believe the market's going lower, so it's always in short, even though the follow-through bar is a bull bar. A lot of traders will just sell at the market as soon as the bar closes, so they sell the close. Double bottom. Do the bears get out above this bull bar? No, most would not. It has a pretty big tail on top. Looks more like a trading range than the start of a bull trend. Wedge bottom, 1, 2, 3. Whenever you have a double bottom and a breakout, and the breakout reverses up, it's a wedge bottom. 3 pushes down, 1, 2, 3. And now we're getting a higher low major trend reversal. Probably not enough bars. We're up 5 or 6 bars and only down 5 or 6 bars. The pattern might not be big enough for a major reversal, but it might be. A lot of the bears would get out. We have a double bottom, higher low, double bottom pullback. You call it a triangle. We have a wedge bottom, 1, 2, 3. Try to reverse up twice, pull back, not a strong sell-off. The bears will be getting ready to get out, and they might get out above here. They might wait for this bull close. They might even get out here. This pattern is fairly small for a major reversal, but sometimes small patterns still lead to a trend. Stop entry traders might buy on the reversal up, a double bottom, higher low, triangle, and then a bull breakout above the bear channel, wedge bottom, 1, 2, 3, or 1, 2, 3. Different computers use different bars, or 1, 2, 3. A lot of times you'll get wedges that when they're setting up, it's so obvious it's going to be a wedge. The third push does not fall below the second. So a lot of traders would see the wedge as 1, 2, and 3, where the third leg could not fall below the second. And the reason that happens is when the market's obviously trying to form a wedge, traders will be very eager to buy, and they're afraid that we might get a double bottom or a higher low. So instead of waiting to buy below this low, they'll start buying as the market's going down. And if enough of them do it, the third push down does not fall below the second. You can call it something else. You can call it a double bottom. You can call it a higher low, major trend reversal. But I think of it as a wedge. There are 1, 2, 3, and 3. Too many traders front ran the buy, and they bought before the market fell below the prior low and reversed up. Some bears might sell here and then get out somewhere over here. And other traders want more trades. They're willing to take a lot more trades, hoping that they can make more profit. They don't mind the extra decisions that you need to make if you're entering and exiting repeatedly. as long as they can make them correctly and they're happy and comfortable trading that way, it's certainly an okay thing to do. Here we tried to reverse up. 1 leg, 2 legs, 3 legs, so a wedge bottom. Strong enough breakout for a second leg down? Well, that's a second leg down. That could be the end of the trend. I think the channel down is very tight. Only one significant bull bar on the way down. So this is probably a minor reversal, buying above this bull bar, and a minor reversal usually leads to a trading range. Let's say you bought above this bull bar. Are you convinced it's always in long here? No, the bulls need to do more. If you're a bear, you sold here and you reversed along here, and we're still always in short, you have to look to sell again. Usually you wait for a bear bar and sell on the stop below its low. This is only a doji, so not a strong sell. A double top bear flag, right here and here, double top bear flag. But doji signal bar, not good. However, at this point, we have a bear bar closing near its low. You can call it a triangle. First push up, second push up, third push up, fourth push up, and then you get a bear bar. That would be a place where I think a lot of the bears would sell again, and the bulls who bought here would sell there as well. If you sold here and you get out here, you got to get short again. If you're an always in trader, if you're trying to stay in the market all the time, you have to get short when the market starts to turn down below a bear bar, when the market never really became always in long. We got a triangle, 3 pushes up, 1 or 1, and then 2 or 3 or 3. And a bear bar closing below its midpoint. I think the bulls get out there, and the always in bears, if they get out here, they have to sell again here. Big bull breakout, closing far above the high of the past 10 or 20 bars. So the market's clearly always in long, despite this terrible follow-through, and therefore traders will buy for any reason. A lot of traders, when they see a breakout bar like this, they're buying at the market. Other traders wait for the bar to close, and if it closes near its high, they'll buy at the market, and they get filled on the open with the next bar. So you buy that close, you buy the bear close, betting that the bear reversal will fail. Buy below the bear bar, betting the reversal will fail. Buy above the bear bar, betting that the bull trend is resuming. No matter how you do it, the odds are we're going up, and that we'll go up for at least a measured move, or about a measured move, based from the open of this bar to the close of the breakout bar. Up here would be the target. Now, if you're a bull scalper, easiest thing to do is every time you see a pullback in a bull bar, you buy on a stop just above the high. You get filled here. Another pullback, bull close near its high. You buy on a stop above that bar, get filled here. And the same is true here. And here we got a triangle, 3 pushes down. 1, 2, 3. You can call it a wedge, you can call it a high 2. Bulls will buy above that bar. And here's a pullback from the breakout of the triangle. Very small pattern. If you draw a trend line across these 2 highs, we have a bull breakout. Chances are the pullback will be a bull flag, and we'll get at least a second leg up. This is a euro versus the dollar 5-minute chart. And the range is fairly big, so a lot of traders, instead of scalping for 10 pips, might scalp for 20 pips. So if a trader bought here, he'd get out 20 pips higher. Same here, get out 20 pips higher. Each of these blue boxes is 20 pips. So if he bought on a stop above that bar, this went up more than enough for him to get out with 20 pips. Again. So he ended up with 60 pips profit. A couple of the times, like buying here, you probably get out around break even. Buying here, same thing, maybe get out break even. Of the 6 trades, 4 were profitable and 2 were break even. 1, 2, 3, 4, 5, and then it's 5 trades. And if he managed them correctly, he would make 60 pips. The problem is, that's a big if. Will he manage them all correctly? Hard to do. And will he take all 5? Hard to do. He probably will not make 60 pips as a scalper. On the other hand, let's say a swing trader bought here, and he just held as long as the market was going up, and as long as he believed his premise was valid. You got a triangle here, up and down here, so down here, down here, down here, and a bull breakout of the triangle. Now we have a wedge top, 1, 2, 3, and we have a bull trend, bear breakout, higher high major trend reversal, micro double top, and a bear sell signal bar. A lot of bulls will get out below that bar or below this double top, and a lot of bears will start to sell there. Bulls bought here and exited there, and that is 78 pips. The trading was easier than for the scalper, and the profit was greater. Most traders in general, when they see a reasonably strong trend like this, should swing at least part of their position because the odds are very good that they will make more money swing trading than scalping, even though theoretically they might make about the same. Here's the euro versus the dollar 60-minute chart, clearly always in long. Not enough to make it short, so it's still always in long. Traders will buy pullbacks either above that bar or above this bar. However, we traded down here for 5 hours, so it might be always in short. On the 5-minute chart, this rally is this, and we have a wedge, 1, 2, 3. And a lot of the bulls will sell to exit, and a lot of bears would sell to go short, looking for a couple legs down. 1 pullback, maybe 2, maybe 2. But a swing trader here on the 60-minute chart would not get out. An aggressive trader, he'll look at the 5-minute chart and he'll get out and maybe sell for a scalp down. The point here is just because you're always in long on one time frame does not mean you're always in long on a smaller time frame. And some traders will switch to the smaller time frame and get out or even take the short. In general, that's not how I trade. If I'm trading a 60-minute chart, I only make decisions based upon the 60-minute chart. And if I'm trading a 5-minute chart, I'm only interested in what's going on with the 5-minute chart. In this video, I talked about swing trading and scalping when the market is always in long. And most traders will make more money if they swing trade because they will not take all the scalps or they will not manage the scalps properly. So if the market is trending and it's clearly always in long or clearly always in short, most traders should simply swing trade. This is Al Brooks, and this is the third of 3 videos on always in trading. Thank you for watching the Brooks Trading Course. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on trends. I'm going to begin by talking about what exactly I mean when I use the term trend. Next, I'll move on to the most important feature of bull trends, and that's that it needs higher lows. And finally, bear trends need lower highs. In a trend, prices move mostly in one direction. So here, lower left, upper right, even though the market went sideways for a couple of times. Also, trends are contained within channels. All trends are contained within channels. Some channels are very steep, but the channels are there. There's a trend line below and a trend channel line above. The trend channel line can be simply a parallel of this line, or you can draw the line connecting tops. Now, I said every trend is contained in a channel. The channel might not be all that obvious, but it's there, and it's important to learn how to recognize it. This is a bull trend bar. Bull trend bar. A trend can be as small as a single bar, and it could be as large as the entire chart. Here we had a trend lasting 2 bars going up, and then many bars going down. When I use the word trend, I'm talking about a major trend, even though I don't always say major. And there are at most 1 or 2 of them on the chart at any one time. If you see 3 or 4 trends on the chart, those trends are minor, and I usually don't use the term trend to describe them. I usually refer to them as swings or legs. Here we have a bull trend. Is this a bear trend? I would call it more of a bear swing. It's about a 50% pullback of this bull trend, plus it's much less strong than the bull trend. And is this a bull trend? Again, I would call it a swing. It's less than half of the bars on the chart, and it's not particularly strong. So to me, this is a bull trend, followed by a bear swing and a bull swing. I said that a bull trend has higher highs and higher lows, and it's contained within a rising channel. The bottom line is the trend line, the bull trend line, and the top line is the trend channel line. Trend line, channel line. Some people refer to both as trend lines. So some people will say this is the bottom trend line, that's the top trend line of the channel. I usually refer to the upper line as the trend channel line. In general, traders like to put their stops below the bottom of the most recent major high or low. Here we have a major low. We don't know if it's a high or low, but it's certainly the start of this bull trend. And traders like to put their stops just below there if they're buying. Is this a major high or low right here? No, I talked about this in earlier videos. A major high or low is one that has a very strong bull breakout and usually results in a new high. And this did not get to a new high, and it's not a very strong bull breakout. So it's a minor higher low right here, and that is not a good location for a stop. You still keep the stop down here. Whether you're swinging or scalping, your stop is down here. Again, don't put your stop below minor higher lows, because too often you'll get stopped out and the market will then resume up after going below your stop. Stop below here, 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 all are bad stops. The correct stop is down here. Again, it doesn't matter if you're swing trading or scalping. This is where your stop goes, below the bottom of the last strong leg up. So if you put your stop below this bar or below that bar or below this bar, you would have been stopped out, yet the trend would have continued. This is not enough to change the premise that the market is in a bull trend. It's a pullback, you can call it a trading range, but it's still in a bull trend. I'll raise my stop if the market reaches a new high, or if there's a strong bull breakout. One bar usually is not enough, but here we got a couple decent bull bars and a new high. And this low followed these lows. It went to a lower low. Most bulls would conclude that if we go to a new high and drop below this low, we're no longer in a bull trend. We're not necessarily in a bear trend, but the bull trend has ended. Traders would then view the chart as being either in a trading range or possibly in a bear trend. This is a good location for a stop after you have this bull breakout. A lot of traders might still keep their stop down here, but most would not. After you get a new high with a couple decent bull bars and you're getting a failed breakout below the trading range, that combination of factors is enough to make this a major higher low, and the bulls should not allow the market to fall below it, if their premise of a bull trend is still valid. I said that if the market falls below a prior higher low, it may be converting into a trading range or a bear trend. But if it falls below a minor higher low like this, all it's doing is converting into a flatter bull channel, a broader, flatter bull channel. We have a very tight bull channel here, but at this point we start going up. The channel now is broader and flatter. This is what I mean. I mentioned that bull trends need higher lows. They're even more important than higher highs, because the higher lows determine where traders put their stops. So if the market falls below a prior higher low, below here, it can still be a bull trend, but it might be a broader, flatter, weaker bull trend, closer to converting into a trading range. And it's possible that it could even be converting into a bear trend. Typically, though, when you have a trend that's strongly up, it's not going to go directly into a bear trend. It usually first has to convert into a trading range. So we got a strong bull breakout to a new high. So this then becomes a major higher low. Once you see this, bulls raise their stop from here to there. So they trail their stop, they tighten their stop. This is not going to convert into a trend in the opposite direction by falling straight down. Probably the best the bears get is a trading range, and they usually typically need at least a small double top. If you're a bull trend trader and you see this, we have a double top, you can call it a wedge, 1, 2, 3, decent bear bar, bad follow through but no bull bar, some more bear bars. So now you have 6 bars down, 5 bear bars, and you fell below a major higher low. Probably the bull trend is over, and probably the market is either in a trading range or a bear trend. It's about a 50% pullback from this rally, so the bulls will stop themselves out as the market falls below that low. However, it's still probably at least a trading range. The bears probably will need a major trend reversal if they're going to convert it into a bear trend. And that's what they got. They got a wedge lower high, 3 pushes up, 1, 2, 3, wedge lower high, decent sell signal bar, and they converted it into a bear trend. It still could be a large high 2 buy, leg 1, pullback 2. It's holding above this low, but I think most bulls get out below that low or above this bull bar, and bears would short somewhere in here, or they would short this wedge lower high for a swing down. Bull trend, in this case it's a fairly broad bull channel. We have higher highs all the way up, we have higher lows all the way up. And after each strong breakout to a new high, bulls will raise their stop to below the most recent higher low. And you can see, after each strong breakout to a new high, when there's a pullback, it did not fall below the most recent higher low. This did not fall below that, and then a strong breakout to a new high, major higher low. Market tried to reverse down, terrible follow through, it became a bear trap and the bull trend resumed. So each reversal attempt held above the most recent prior high or low. That's one of the hallmarks of a bull trend. In a broad bull channel like this, you often have pretty strong sell-offs. We have many of them here. And sometimes the sell-offs are even strong enough to convert the market into always in short. In other words, an early bear trend. However, unless the bears are able to get below major higher lows, even if it becomes briefly always in short, the odds are the bull trend will continue. I would say that this market was not short. I think even though we had pullbacks here, 10 bars, 15 bars, I think it stayed always in long because the bears failed to get consecutive big bear trend bars. They have two bear bars here, but a tail and followed by a bull bar. So to me, this is not enough to convert the market to always in short. Sometimes when you have a broad bull channel, the market will sometimes become always in short, yet the market can still be in the broad bull channel. I'm always drawing lines on charts. You start with what you have in front of you. As more bars get added to the right, you have to adjust your lines. The lines are rarely ever perfect. At this point, I'm using these lines, but then the market falls below here. Then I use this point for my line, but it's still a bull trend. It's just flatter. It's not as vertical, and it's also broader at that point. So you can see here, we fell below the blue line, so now we have a new low. The market rallied. This is now my trend. And we fell below that line, so when it starts up, I'll replace this line with one down here. And when you get to the bottom of channels, bulls like to buy reversals up. So they buy above this bar, and they buy above this bar, and they buy above that bar or this bar. I said that we had reversal attempts repeatedly in this broad bull channel. None of them was strong enough to convert the trend to always in short. And the bulls expect all of these reversal attempts to fail. So when they see a bear reversal attempt, what are they doing? They're buying. Anytime there's a broad bull channel and it pulls back somewhere into the middle of the last leg up, bulls buy. Okay, we have a rally, pull back somewhere in the middle third, bulls buy. A rally, pulls back to the middle third of that last rally, a buy. Rally, pull back somewhere into the middle of that rally, bulls start looking to buy. And then they tend to take partial profits at new highs, and that's what, in part, creates the pullbacks. And bears see something really important. So let's say you're a bear, and you see this right here, okay? A new high and a pullback that fell below this high. Well, what are you going to do if you're a bear? Well, you'll see this high. You're going to place a limit order to sell at that high, betting that we'll drop back down below this high, because that's what we did before, and trends tend to weaken as time goes on. So bulls are buying pullbacks to the middle third of the last leg up, so they buy somewhere in here, and bears are starting to sell new highs, and bulls sell at new highs as well to take profits. And bulls like to see these reversal attempts. As long as the market's continuing to make higher lows, they assume the trend will continue. So whenever they see a reversal attempt like this or that or this, guess what? They buy it because they expect the reversal attempt will fail. So the bulls will buy bear closes and they'll use the appropriate stop. A bull buying this close, his stop is below the most recent major higher low, and he bet that the bear reversal would fail and that the trend up would continue. Same with here. You could buy that close. You could buy below that bull bar because it's a bad looking sell. You can buy that bear close. Another attempt to reverse. You buy that close. I wouldn't draw this as a trend line here, here, and extend it across. However, either one of these you can use for the first point of a line, and then here's an obvious second point. We reverse down. And to find the bottom of the channel, you could either simply use lows, like draw a line from here to here, or you can use a parallel line. At this point, we know the market was turning down here. Maybe it'll fall to the bottom of a channel that is created from a parallel of that line. Once we start to turn down here, a lot of traders can see an obvious top of a channel, and they'll create a parallel of it and drag it down to a bar that contains all of the bars. Would I drag it to this bar? No, because these bars would then be below the channel. I want to drag it down to the bar that would result in the channel containing all of the bars. And then traders will look to buy a reversal up. Channels are rarely perfect. There's usually some problem with every channel, but it gives you an idea of what the market's trying to do. And if the market's near the bottom of a channel, traders look to buy for a reversal up. And if it gets near the top of a channel, they look to sell for a pullback. Just like a bull trend needs higher lows, a bear trend needs lower highs. A bear trend has lower highs and lower lows, and is contained in a falling channel right here. So here we have a spike down, a pullback, and then a bear channel. Now, this is a major lower high. We have a reasonably strong breakout to a new low. A lot of bears will put their stops above that high, and I cannot tell if this went above that. It looks like it might have. And if a bear did exit on a stop above that bar, he would look to sell again on a reversal down because of a possible double top bear flag. So double top bear flag, neckline, looking for a measured move down. The top of the channel is the bear trend line, and the bottom is the channel line. So bear trend channel line. In a bear trend, bears want to put their stops above the top of some major sell-off. Here we have a very strong bear breakout, so bears selling anywhere this close at the market, above this bar, below that bar, doesn't matter. Their stop is still above this high. So it's above the most recent major high. Let's say we're at this point. Is this a major high? Will bears lower their stops from here to here? I don't think so. That's not a particularly strong bear breakout and did not get down to a new low. The bears who shorted for any reason still have their stop up here because they know since this is not a major low, the market could easily go above it and still be in a bear trend. So we can get a low 2 or a wedge bear flag. So we can get one more slightly higher high, another slightly higher high, and still be in a bear trend. If you're selling for any reason, your stop is above the top of this major sell-off. This is a bad location for a stop. Like I said, you could easily get a two-legged pullback. 1, pullback, and then 2, going above that minor lower high, and then the bear trend could resume down from the low 2 bear flag. And that's what happened. 1, pullback 2, we have a two-legged bear flag, a low 2 short, double top bear flag, decent sell signal bar. A bear who sold down here, anywhere in here, and then put a stop just above that lower high, lost money in a bear trend. And if the bear made that mistake, he should get short again as the bear trend resumes down, so he would sell again below that bear bar. Now, here we have a low 2 bear flag, a failed breakout, a failed reversal attempt, and then we broke out fairly strongly to a new low. At this close, a lot of the bears will tighten their stops. They'll say, oh, this is pretty major. We got a new low, and we have a pretty decent bear bar, and that's after trying to reverse up. So the market should not get above this bar. If it gets above this bar, then the premise of a bear trend is probably no longer valid. The market would then either be in a trading range or in a bull trend. And if you're trading it like a bear trend, and it has become a trading range or a bull trend, you want to get out because your premise of a bear trend is no longer valid. So after a strong breakout, this becomes a major lower high, and bears will take their stop from here and put it to just above there. Pretty tight channel. And if the market trades above a lower high, as it did here, it's probably not going to be a bull trend, but it could be a weaker bear trend. It could be a trading range, but more likely it's going to be a weaker bear trend, broader, flatter. So initially we had this as the bear trend, very tight. And then once we have this lower high, we can draw a line here, still pretty tight. And now we have a new high above both of those possible bear channels. So now we have a new channel from this high to that high. And it's broader and flatter than the other channels. Here we got a bear microchannel, so it's a breakout on a higher time frame chart. And we have a series of lower highs and lower lows. Is this a major lower high? Probably is. Had a pretty strong bear breakout and follow through. And it made a new low. And then also, we're trying to get a bear breakout below a bear channel. So if you connect these lows, that would create a bear channel. And here, we're trying to break below it. That's not a good thing. 75% of bear channel breakouts, where the market breaks below the bottom of a bear channel, 75% of them will reverse up to the top of the channel, or to the top of the most recent sell climax, this bar, maybe that bar. But in any case, if you're short and you are going to exit on a stop, your stop now is above this bar or above that bar. Both of those are reasonable. And what happens if you get stopped out? Is it a bull trend? No. A tight bear channel like this usually cannot then become a bull trend. Usually the best the bulls can get is a trading range. And if the bears are unable to resume the trend down, the bulls have a shot at a major trend reversal within that trading range. And at that point, the probability of the bulls taking control is better. Usually, the first breakout of a channel results in a minor reversal and a trading range or a bear flag, rather than a bull trend. The bears got stopped out here in a strong bull bar, and a pretty good reversal, strongly down, strongly up. probably a minor reversal. Some bears will sell below this bar on the failed breakout above these bars. Others will wait to see if we get a series of bear bars, 3 or 4 bear bars, and then sell, or if we get a micro double top. Strong enough bull bar, probably at least a minor second leg up, likely. And in this particular case, we got a particularly strong leg up. It went above all of the highs in the channel, did not get above the top of the bull trend. So what do? Well, a lot of traders would sell below that bar. 2 legs up, 1, 2, or a wedge, 1 or 1, and then 2, 3, or 1, 2, 3, different ways to draw it. We'll look at this as a possible second leg trap in a developing trading range. First leg up, pull back, second leg up, terrible follow through, and pretty bad follow through. And we did not get above this high, so this is probably a bull leg in a trading range. A lot of bears will sell that, and the bulls probably would get out because disappointing follow through despite a strong bull breakout. All trends are constantly trying to reverse. So here we have a bear trend, lower highs, lower lows, constantly trying to reverse. And sometimes the reversal up is strong enough to make the market always in long. Here we have a bull breakout above this lower high, and then a follow through bar. Tail on top, not especially big, but probably always in long. Pretty common when you're in a broad bear channel for the market to become always in long. However, usually the bear trend resumes before the market gets above a major lower high like this or like that. Even though the market rallied up strongly, especially here, in many attempts to reverse up, every rally resulted in a lower high. So it's still a bear channel. And traders will look to sell the reversal down. Now, you have a bear bar and a follow-through bar, bear bar. Do you put the stop above this high or above that high? No, this is a minor lower high. Did not have a strong bear breakout, did not get to a new low, and therefore putting a stop just above the high of that bar is a low probability bet. You're throwing money away. You still have to rely on your swing stop. Now, what about this? Is this a good enough major lower high so bears can put their stops above it? Maybe. This is not a strong bear breakout, but it is a new low. A lot of bears will not put their stop above here. They'll keep the stop up here. If the bears do put their stop just above this bar and they get stopped out here, they'll look to sell a reversal down, either below either of these bars or below here, betting that the rally does not look strong. It looks more like either a bull leg in a trading range or a bull leg that becomes a bear flag. Bears, they see these strong rallies and they say, yeah, it's a strong rally. Maybe it's even always in long, but it did not get above the top of this major lower high, and therefore it's probably going to fail and become a bear flag, so bears will look to sell. The same with here. You can say, oh, we rallied for 15 bars. That's pretty bullish. It is, but it lacked consecutive big bull trend bars closing on their highs, and it did not get above the most recent major lower high, so bears will be selling here. Again, channels are rarely perfect. You can see the way I drew it, I connected this high and that high and ignored this bar going slightly above, and we're trying to go slightly above again. Traders don't really care if it hits the channel exactly and turns down. They care that it turns down somewhere around the channel. So bears are looking to sell on a reversal down from the channel, the top of the channel, somewhere around the channel. A lot of traders prefer to sell below bear bars, so some traders would sell below this bear bar. Others would take the short below this doji bar. And then same over here. You could sell below that bull bar or below the bear bars. And here you could sell below the doji. You could sell below the bear bar. In this video, I talked about how I use the term trend. I also talked about the importance of bull trends needing higher lows and the importance of bear trends needing lower highs. As long as a bear trend is forming lower highs, traders believe the premise of a bear trend is still valid. If the market gets above a lower high in a bear trend, the bear trend probably has ended and has evolved either into a trading range or, less likely, a bull trend. And the opposite is true of a bull trend forming higher lows. If the market falls below a major higher low, the bull trend probably has ended and has probably converted into a trading range. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on trends. This is Al Brooks, and this is the second of 5 videos on trends in the Brooks Trading Course. An important point when you're looking at any chart is that if it's not particularly clear, the chart is in a trading range. Next, I want to talk about how trends can be in a breakout phase or a channel phase, and the breakout phase is the strongest part of a trend. And finally, I'll talk about the 80% rule. Markets have inertia, just as trading ranges tend to resist breaking out. 80% of breakout attempts fail within a trading range. When the market's in a trend, it's constantly trying to reverse, but 80% of the reversal attempts will fail. Look at this chart. We're strongly bearish. We're strongly bearish again and again and again. And then we're strongly bullish and again and again. So is the market in a trend? Well, if it's not clearly in a trend, you have to assume it's in a trading range. It's making strong bull breakout attempts, strong bear breakout attempts. So there are good arguments for the bulls and for the bears. That's one of the hallmarks of a trading range. Whenever the market is not clear and both the bulls and the bears have reasonable arguments, the market is in a trading range and you have to trade it like a trading range. I said that every trading range has both bull and bear arguments. Well, every trading range also contains the start of both bull and bear trends. For example, look at this. We're getting lower highs, and if this chart continued down, you would say that the bear trend began here. Likewise, here we got a double bottom. And let's say we break above the neckline and go up for a measured move and start a bull trend. And you look back at this chart and ask yourself, well, where did that bull trend begin? You would say here. However, at this point, right here, we're still in a trading range. So it has an early bull trend and it has an early bear trend. In this particular case, we have lower highs and we also have higher lows. Just as every trading range contains trends, trends contain trading ranges. Every pullback and pause is a small trading range. And you can tell that by looking at a smaller time frame chart. Here, there's no actual pullback, but it's still a pause in a trend. Here is an actual pullback, and a pullback is a small trading range. So this is a small trading range. This pullback is a small trading range. It extended on and formed a 10 or a 15 bar trading range. Yet we're still in a bull trend. Once a trading range goes on for 20 bars or so, the probability of a reversal becomes almost as high as the probability that the trend will resume. I always look to the left, and whatever to the left is, that's what is always going to be slightly more likely the market will do at some point. So when I'm trading in here, when I'm looking at the market here, and it's confusing, are the bulls or bears in control? Well, the most recent clearly always in setup was here. The market was clearly always in long. So all through here, the probability is slightly higher that we'll get trend resumption up instead of trend reversal down. But every bar that gets added to the trading range reduces the probability for the bulls. And at some point, after 20, 30, 40 bars, the probability of trend resumption up falls to 50%, and the probability of trend reversal down rises to 50%. I talk about always in trading, and if the market is clearly always in short, it's far easier to make money selling, so it's better only to look to sell. We're trying to reverse up repeatedly, but the channel is very tight. I don't have the lines drawn, but it's a very tight bear channel. So all of these reversal attempts are minor, which means they'll lead either to a bear flag or a trading range. So traders look to sell every reversal down from a pullback. This bar pulled back above that high, so it's a pullback below one short. Here we pulled back for a few bars, and it's a short here. You can also call it a double top lower high. And here we pulled back for a few bars. So it's far easier to make money selling when the market is clearly always in short. Also, it's easier to make money if you swing trade. If you sell for any reason, here or here, it's better not to take quick profits. If you're a very skilled trader and you can buy back your shorts and then sell again, buy back your shorts and sell again, you'll do fine. But very few traders can do that. And when a channel down is this tight, it's far better to take any short and just hold until there's a clear end to the trend. For any trade, whether you're in a trend or in a trading range, you should always have protective stops. And they can't be simply in your head. They have to be in the market. Let's say you buy above this bar. You might immediately place a stop here. It's a 50% pullback, a very strong reversal up, high to buy. Most bulls will not let it fall below this bar. And if it does, they'll question whether it's still in a bull trend. So the bull immediately places the stop there. The bears will look at this and say, oh, we were trending up, and then we got a bull breakout above this tight bull channel. So we're trying to get a bull breakout above the tight bull channel. It's an exhaustion bar. Every big bull trend bar is an exhaustion bar. And the gap closed. The gap between this close and that high, we closed it over here. So maybe the bull trend has ended, and maybe we're in a trading range. Maybe we're, in fact, in a bear trend. The bears will look at this as a lower high. Not enough bars for a major reversal, but certainly enough bars for a minor reversal, a swing down. And the bears will look at this as a double top lower high. In any case, The bulls who buy here cannot have a protective stop in their heads. They have to have the stop in the market just below the low of this bar, because sometimes you get this. It happens often enough. And if you don't have that stop there taking you out, you'll keep coming up with reasons why you should continue to hold on to your long position, hoping that it will reverse up. And you cannot do that. A breakout is the strongest type of trend. It can be one bar, it can be many bars. The bars are really scary for beginners. They look at this and the market's not doing much of anything at all, so it's pretty peaceful watching it. And then you suddenly have to change your way of thinking when you see a big bar like this. Far bigger than all the prior bars, 10 times bigger, closing far above the high of all the other bars. So we're no longer in a tight trading range. We're now in a trend, a very strong bull breakout. High probability that we're going higher. But here, you could use very small stops. The bars are small, the market's sideways. Here, you now have to use a wide stop below that bar, below this bar, probably below all of the bars. It's very easy to miss the trade. You're denying that it's the start of a trend. Well, chances are it is the start of a trend. Chances are that means high probability that it's going to continue higher. High probability of a profit if you buy. Yet, stop far below, so risk is great. And that's always the case. Whenever you see something that has a high probability of predicting something else, like higher prices, your risk reward is going to be bad. Usually your risk is big because the stop is far away due to how fast the market moved up. You have to get long. Even if it's a small position, you have to get long. And what I talk about in this course constantly is ways to get long. You have to train yourself to react reflexively. You see this, you know the market's no longer in a tight trading range. The market has changed. You need to get long, and you can simply buy closes. You can buy the close of the breakout bar. If you want higher probability, you wait to see if the next bar has a bull close, and then you buy that bull close. And how do you buy it? You can just hit the button, buy the market. Or you can place a limit order as soon as this bar closes to buy at the close of that bar. But the easiest thing is when you see that second bar having a bull close, just hit buy the market. Again, stop is far away, so you're risking a lot more money. You have to trade smaller. You can put your stop below the breakout bar. If this is going to be a successful breakout, it should not trade below such an exceptional bar. You could also put it below the entire bull leg. Both are reasonable. And the odds are, whenever you see a breakout that is as big as this, it's going to result in some kind of a measured move up. Maybe simply based upon the open of the bar to the close of the bar, measured move up here. But it certainly has at least a 60% chance of resulting in higher prices and some kind of a measured move up. I think one of the hardest things for a beginner is all they think about is risk. I can't lose money. I work so hard to get this account so that I can trade. And if I lose my money, I lose my trading career. I die. My trading career has died. So all they focus on is risk. And because of that, they're always looking for the tightest possible stop. And they're also always waiting for pullbacks because they think, well, I don't want to buy up here because my stop is too big. I can't afford to risk that much. While they wait, the trend can continue up a long way. They have to get used to just buying at the market. They see the market's going up, tight channel. It's a breakout on a higher time frame. You just buy at the market, put a stop down here, go for a walk for 15 minutes. And if that's what you have to do to stay in the trend, because this tight bull channel is a breakout on a higher time frame chart, that means the odds are we're going higher. That beginner now, his stop is all the way down here, so his risk is even greater. So he's even more afraid, and he's going to keep waiting for a pullback instead of looking at the chart and saying, wow, this is going up, and it may keep going up. I should just get long. Well, the beginner is hoping for that pullback, and he misses a whole rally. If you are a bull and you're long for any reason, let's say you bought somewhere down here, your stop is down here, and that stop is probably much bigger than what you typically use, and that means your risk is greater than normal. So what do you have to do? Well, if you're a computer algorithm, you have to do something to make sure that your risk does not get too big. The easiest thing to do is to reduce your position size. So even in a strong bull trend, bulls have to take profits at some point to reduce their risk. And when the bulls take profits, it creates a bull flag. However, beginners don't see it that way. When they see that pullback, they see a trend reversal, a reversal into a bear trend. This is profit taking from the bulls. Trying to reverse, trying to reverse, trying to reverse. See, it went up and down. Mostly profit taking from the bulls. It's a mistake to be selling even with limit orders when the channel is this tight. All of these reversals are mostly profit taking from the bulls. And as soon as it comes down a little bit, other bulls who have been waiting for a pullback are buying. Even if it drops just one bar below the low of the other bar. Here, one bar below, one bar below, one bar below. Traders who are flat or who do not yet have a full position are buying even the smallest pullbacks. That means there's a lot of urgency on the part of the bulls. If you get a big enough pullback, what becomes a major high or low, computers will tighten their stops to below that major high or low. And then anyone who buys after that point, they have a stop that is higher up, so the risk is less. So look at this trend. We have 1 and 2 bar pullbacks all the way up, and they do not drop very far, and the market keeps working higher. The sell signal bars do not look all that strong. When the bulls look at all of these reversal attempts, what they see is a bull flag forming, and they're looking for a reversal back up. So they're expecting the reversal down to be just a bar or two, and the bulls will buy with stops above the reversal bars, the bear breakouts. And the beginner looks at it and says, that's still too high for me to buy. I want more of a pullback. The beginner does not take the trade. He says, my stop still has to be down here, and I cannot risk that much. And what he should be doing is buying small, and just buying the tiniest position that he could buy at any point. Take any one of these high 1 bull flags and use the appropriate stop. So the beginner ends up missing a trend that goes on for 10, 20, 30, 40 bars. And the beginner oftentimes starts to think, okay, this is going on way too far. It's unsustainable. It's climactic. And therefore, it should reverse. The trend cannot last forever. All strong trends are constantly forming wedges. 1, 2, 3, 1, 2, 3, 1, 2, 3. However, when the channel is this tight, all of those wedges are going to fail. The beginner only sees the wedge. He doesn't see the tight channel, and he does not see the low probability. So that beginner who did not buy any of this now sees a reversal down, and he says, okay, a lower high, I got to sell. Maybe we'll get leg 1, leg 2, measured move down, leg 1, pull back, leg 2. And my stop is small. So if I sell below here, maybe my stop is here, maybe my stop is here. So I'm not risking very much. Yes, he's not risking very much, but he has terrible probability. When you have a tight bull channel like this, the first reversal down is minor, and the bulls will buy it. Here we have a first reversal down, and guess what? Strong bulls are going to buy it. So that beginner who's been waiting for his pullback finally has his pullback, and he's selling far below the high, far too much below the high. And he's selling where smart bulls are just waiting to buy. So maybe the beginner will sell this bear flag and put a stop just above the high of that bar because he wants to reduce his risk. And that's just a terrible mistake because most reversal attempts fail, and this, I think, is a bull flag and more likely to go up. If it keeps going down for 20, 30, or 40 bars, then the probability is that we're in a bear trend, even though we did not have a major trend reversal. But at least 70% of the time, when you have a channel this tight and you get a bear breakout, it's going to be a bear leg in a trading range, and the bears will need a major trend reversal. In other words, they'll need one more attempt to resume up, testing this high, and then a second entry short, double top. First reversal down, and then a rally, and a second reversal down. And without that, chances are any reversal attempt is going to be minor, and the bulls will buy it. 80% rule. If the market's in a strong bull trend, it's always going to be forming tops, usually wedge tops, but 80% of the tops will fail. Here we got different ways to draw a wedge top. Talked about that a few minutes ago. And the beginner selling this lower high is betting on, well, maybe it's not quite a major reversal, but it's certainly a big reversal after a buy climax, and therefore we should fall further. No, that's not true. Very tight bull channel, first reversal down, probably bulls will buy it. Bulls were buying 1 bar pullbacks for 10, 20, 30 bars, and now they get a chance to buy a 5 bar or a 10 bar pullback. Well, a lot of them will take that chance. If they were willing to buy a 1 bar pullback, and now they get to buy a much bigger pullback, and there's no clear, convincing top, they're going to buy. So the bear selling down here is selling at the bottom of what is at best a trading range, and at worst it might be a pullback in a bull trend. Most of these tops become bull flags, and here you can call this a wedge bull flag, you can call it a high 2, you can call it a small double bottom. Different ways to draw the wedge. We got a slight pullback here, so first push down became a doji, and then second push, third push, or you can say first push down, second push down, third push down. Doesn't matter. A bear channel is a bull flag, especially in a bull trend. Bulls are going to be buying a reversal up from that bear channel, expecting the trend to resume up. So that bear who took this short below that bar and put his stop just above at this yellow line because he did not want to risk much, lost money. The probability was probably 80% that he was going to lose money. So yes, he took a low risk trade. He did not lose money, but when he takes this trade, he's going to lose 80% of the time. And the 20% of the time that he wins he will not manage it well enough to overcome those losses. So in a strong bull trend, the first reversal down is a bull flag, not a reversal. Yes, the beginner says, okay, well, at least I did not lose much. Well, if you lose a little bit of blood 1,000 times, you've lost a lot of blood. These small losses add up, and you can end up losing a lot of money. Now, that beginner might think, okay, it's way overdone, and this didn't work. Now we got 2 legs up here. Maybe it's a wedge, 1, 2, 3, and maybe a second entry short up here is worth taking. While it's a credible higher high major trend reversal, bull trend, bear breakout lasting a lot of bars, 10 or more bars, and then resumption up, and then we got a second leg up from here. This was likely to have a second leg. Well, we have it. So there are decent reasons to sell, except one. Very tight bull channel, a bear reversal is probably going to be a bull flag, and we're going to resume up. And how big are the pullbacks up here? Really small. You can also call this a tight bull channel, and therefore the reversal down will probably fail. Even though this is a second entry sell, first entry, second entry, failed breakout, new high, it's still not enough selling pressure. Where are the big bear bars? Where is the evidence in the past 20, 30, 40 bars? Where's the evidence that the bears can take control? This is not much evidence. Yes, it's a short, and it's a reasonable short, but it's a very low probability short, and I would not take it. I've talked about this before as well. So you're taking a short, your stop is above this bar, and you say, well, at least my risk is small. Whenever you have a very small risk, you always will have low probability. In other words, anytime you take any trade and you're using a very tight stop, you probably are going to get stopped out for a loss. You can say, well, it's a major trend reversal, so if it reverses down, I'll get a major profit, a very big profit, and that more than offsets the low probability, which is true, but it assumes that the low probability bet will be successful and that you'll manage it correctly. And most beginners will not. They'll get out with a small scalp profit, which means they're taking small reward, and that neutralizes their small risk, so they still have a weak risk reward, and they're taking a low probability bet. So low probability and not a strong risk reward setup, you're going to lose money. What's going to happen to this bear taking this low risk trade? He's probably going to get stopped out, and he did. Okay, that beginner might keep arguing, well, it's got to turn down at some point. It's way overdone. It just cannot keep going up. Probability has to be getting higher. He knows low probability, low probability. All he cared about was risk. And he's assuming that eventually the probability will go up and that he'll make money. Now we got a wedge, maybe a nested wedge, 1, 2, 3, or nested into a larger wedge, 1, 2, 3. So that's certainly higher probability. And look, the risk is small again. So if I sell below that doji, I get filled on this bear bar, and my risk again is small. But small risk usually means low probability, and a pretty tight bull channel, low probability. Bulls probably will buy. It's a credible higher high major trend reversal short. I would not take it. Just not enough bear bars anywhere on the screen to be selling, especially selling with stops too far below the high. That bear sells below this bar, his nested wedge. He gets filled right there on this bear bar, and he sees this bear bar and he's happy, thinking that, okay, this is a higher probability short. It might be, but it's still a terrible short. Chances are bulls will buy that bear close, and that will continue higher. Bulls will either buy the bear close, or they'll wait for a bull follow-through bar, bad follow-through, a failed bear breakout, and they'll buy just above that bull bar, betting that the trend will continue. Like I said, 80% of reversal attempts in bull trends fail. Here, here, here. You just count, look at them all. Look at all these reversal attempts. Yet the channel up is tight. There's an absence of big bear bars. The odds are every one of these reversal attempts will fail, and the trend will keep going higher. Unfortunately, a beginner will look at this and he'll keep seeing wedges. Now we got a new wedge, 1, 2, either one of these bars, or 3. And we're starting to get a pretty strong reversal down. So maybe I'll sell that close or sell this close. Arguing, discipline. I have to be disciplined. I have to stick to my plan. And my plan is that I have to keep shorting this buy climax because it cannot last forever. And my losses are small. Losses are part of trading. And certainly each following reversal attempt will have higher and higher probability because trends tend to weaken. And here we got a bull breakout above a bull channel and a reversal down, so that's certainly higher probability. But it's still a low probability bet. Trends just tend to keep going up, and it's much better to keep buying bear closes betting that the trend will resume back up and that these reversals will fail. So the beginner sees the bear bar, sells here or sells here, stop just above, and he gets stopped out. The bull trend is just way too strong. The pullbacks are too small. They're too brief. And it's clearly still always in long. Traders should only be looking to buy. A huge bull trend day, yet the beginner lost money because he kept betting against the trend. Trends are always trying to reverse. They're always forming wedge tops, but they also can go a lot further than what traders think they possibly can do. So 4 losses, 1, 2, 3, 4. And they add up to a big loss. So a trader lost money during a very strong bull trend because he kept shorting all day, ignoring the low probability. All he sees is a tight stop and small risk, and therefore I'm going to take the trade. But you need risk, reward, and probability to take a trade. And anytime you're taking a very low probability trade, by definition, if it's a low probability win, it's a high probability loss, you're going to lose most of the time. You will lose. So when a trend is strong, clearly always in long, you should only be buying. Why do markets exist? They exist for one reason. They allow people to trade at a fair price. And although you thought the price was too high, the buyers thought it was too low and it kept going higher. They need someone to sell to them, and you eagerly volunteered. And you cannot do that. Whenever a trend is very strong, you don't want to be the only person selling. In fact, you don't want to be selling at all. You can only look to buy. Markets are always trying to make traders trade. That's part of why they exist. They're trying to facilitate trading. They want more trading. So they're always doing things to make people act. They're always going to be doing something that will make traders uncomfortable and make them do something. For example, it makes beginners short all the way up. However, it often has to go very far, much further than what seems rational, to find out how far too far is. And how does it know that? Buyers stop buying. Volume dries up and no one's willing to buy. And then it'll start doing the opposite. It'll start probing down. So as long as you keep selling, you'll have to keep buying back with a loss. And if it cannot go down, it's going to keep going up until there's no one left to buy. Once the final weak bears, like beginners, stop selling, the strong bears begin to sell, and you ultimately do get a successful top. And there's no evidence of that happening on this chart. So a strong bull trend, only look to buy. In this video, I talked about when a chart looks unclear and you cannot tell if it's in a bull trend or a bear trend, it's in a trading range. So anytime something is not clear, it's a trading range. A breakout is the strongest part of a trend, and it's a high probability bet that the trend will continue. 80% rule, most reversal attempts fail. 80% of reversal attempts will fail. So instead of selling in a strong bull trend, you should be buying. Instead of buying in a strong bear trend, you should only be selling. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on trends.